Because we're now facing the convergence of the asset bubbles of 1929 in stocks, the debt bubbles of 2008 in housing and credit, and the government debt bubble that didn't exist in either previous crisis. All three are happening simultaneously. In 1929, only stocks crashed, and only about 10% of Americans were directly affected. In 2008, housing crashed, but the government was able to borrow money to bail out the banks, and the Fed could print money without triggering significant inflation. In 2025, everything is expected to crash together, and the tools used to fix previous crises may no longer be effective. The Fed can't cut rates to zero because inflation is already elevated. It can't print unlimited money because it's already done so, causing the worst inflation in 40 years. The government can't bail everyone out because it's already drowning in $36 trillion of debt. The 12 warning signs that I've outlined, from the inverted yield curve to Warren Buffett hoarding cash, aren't just speculation, they're verifiable facts. They're happening right now. The inverted yield curve, which has accurately predicted every recession since 1950, is signaling that a recession is imminent within the next 3 to 9 months. Regional banks are failing. Commercial real estate is collapsing. Consumer debt is at record highs, and delinquencies are rising. Unemployment is increasing. Insider selling is at levels that typically precede major market crashes. Every indicator is simultaneously flashing red. The timeline is becoming clear based on the yield curve normalizing in September of 2024. Recessions typically follow 3 to 12 months later, placing us in the window of December 2025 through September 2026. Commercial mortgage refinancing peaks in 2025 and 2026. Credit card defaults are already accelerating. The trigger could be pulled at any moment, and once it begins, the cascade will be unstoppable. This isn't just a prediction, it's pattern recognition. The same patterns that preceded the crashes of 1929 and 2008 are present now, only in a more extreme form. When the crash comes, stocks could drop 65 to 80% from their peak, even worse than the 89% drop experienced in 1929 because it will likely be faster and more concentrated. Bonds could drop 35 to 50%, something that didn't occur in previous crashes. Real estate could decline by 40 to 60%, worse than the decline seen in 2008. Unemployment could exceed 15%. And recovery may take not just 5 years, as it did after 2008, but 10 to 20 years or more because the Fed has exhausted its policy tools and the government has depleted its borrowing capacity. The everything bubble has earned its name because everything is expected to crash together, leaving nowhere to hide. Those market crashes recorded in history books, the ones we thought could never happen again because we learned from the past, are about to repeat themselves with a violence and scale that will shock anyone who believes it's impossible. The mathematics of unpayable debt, overvalued assets, and exhausted policy tools virtually guarantee it. The crash is coming. The only remaining question is whether you'll be prepared when it arrives. In 1929, the stock market took a nosedive, dragging America headfirst into the Great Depression. Over just 3 years, stocks lost an unbelievable 89% of their value. Unemployment skyrocketed to 25%. Banks were collapsing left and right. People's life savings vanished completely. It took a whole 25 years for the market to claw its way back to the levels of 1929. Then, in 2008, the housing market completely fell apart, triggering the Great Recession. Stocks plummeted 57% in only 18 months. Unemployment peaked at 10%. Banks were desperate for government bailouts. Retirement accounts were absolutely destroyed. It took 5 long years for the markets to recover. But it's looking like 2025 is going to be different. This time, stocks, bonds, and real estate are all crashing at the same time, in what financial historians are calling, with a sense of dread, the everything bubble. And the thing about an everything bubble is, when everything crashes together, there's just no safe place to run to, nowhere to hide. What if I told you this isn't some completely new, never-before-seen situation? We're basically back in 1928, standing right on the edge of the Great Depression all over again. Except this time, you could argue it's even worse, because the very tools we used to pull ourselves out of the fire after 1929 and 2008 just don't work anymore. The Federal Reserve can't just slash interest rates down to zero because, let's be honest, they're already practically at rock bottom. They can't just start printing money endlessly because they already tried that, and it unleashed the worst inflation we've seen in 40 years. The government can't bail everyone out because it's already drowning in a mind-boggling $36 trillion of debt. Let me walk you through exactly why every single major financial indicator is flashing bright red, screaming for attention. Why the crash window is looming between November 2025 and June 2026, and why the coming collapse is set to wipe out more wealth than any other event in human history. This isn't just some crazy guess. This is simple math, plain and simple. To truly understand why 2025 is going to be unlike any crash we've ever seen, you need to realize that we're not just dealing with one bubble. We're facing three bubbles all at once, a perfect storm of factors that have never all come together before in the history of finance. Let's start with the stock market. The S&P 500 is currently trading at a price-to-earnings ratio of 28, which is nearly double the historical average of 15 to 17. This level of extreme overvaluation has only happened twice before. Once in 1929, right before the Great Depression, and again in 2000, right before the dot-com crash that wiped out 78% of the Nasdaq's value. Both times, the market went into a complete free-fall within months of hitting these extreme highs. But the concentration risk we're seeing in 2025 makes the situation even more dangerous than either 1929 or 2000. Just 7 stocks, Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla, now make up roughly 30% of the entire S&P 500's total market value. This means that if these 7 companies take a serious dive, they're going to drag the whole market down with them. We haven't seen this kind of concentration since 1929, when a small number of industrial stocks were propping up the entire market right before it collapsed. Back in 2000, the dot-com bubble was definitely concentrated in technology stocks, but they still represented a smaller piece of the overall market. Today's concentration is more extreme, more dangerous, and, ultimately, more fragile. Nvidia alone perfectly shows how crazy current valuations have become. The company is trading at a price-to-earnings ratio above 65, meaning investors are paying $65 for every single dollar of profit the company makes. Nvidia's total market value is over $3 trillion, which is hard to even imagine, making it worth more than the entire German stock market, which is the 4th largest economy in the world. This isn't rational valuation by any stretch of the imagination. This is pure speculation, fueled by artificial intelligence hype that is eerily similar to the internet hype of 1999. Everyone strongly believes that AI is going to change everything completely, just like everyone was sure the internet would change everything back in 1999. They were right in the long run about the internet's impact, but they were completely wrong about short-term stock valuations. The exact same thing is happening right now with AI. The second bubble we're facing is in real estate, and it's actually even more overvalued than the infamous 2008 housing bubble that almost destroyed the entire global financial system. As of November 2025, home prices are about 50% above their long-term historical trend when compared to both income and rent. At the very height of the 2008 bubble, homes were only 35% above trend. This means the current housing bubble is a massive 43% bigger than the bubble that caused the Great Recession. Just let that sink in for a minute. The crisis that needed trillions in bailouts and almost brought down capitalism itself was based on a 35% overvaluation. We're now sitting at 50% overvaluation. And the really scary part is that most people don't even realize we're in a bubble because prices have been artificially high for so long that it started to feel normal. But residential real estate is really only half the story. Commercial real estate is in a full-blown freefall, creating a slow-motion crisis that's going to speed up dramatically throughout 2025 and 2026. Office buildings across America are sitting at an average of 45% empty, as remote work becomes the new normal. San Francisco, for example, has an unbelievable 35% vacancy rate in commercial office space. These buildings were originally financed with mortgages when interest rates were around 3%. Now, Those mortgages are coming due and need to be refinanced at interest rates of 7 to 9%. The buildings simply aren't worth enough to cover the new debt payments at triple the interest rate. This will inevitably lead to defaults, bank losses, and a chain reaction of failures that will be similar to the 2008 subprime crisis, except this time it will be in commercial properties instead of residential ones. The third bubble, and this is really what makes 2025 so different from anything we've seen before, is the bond market. Government bonds are supposed to be the safe asset that you can always count on when stocks crash. In 1929, bonds stayed safe even as stocks collapsed by a huge 89%. In 2008, Treasury bonds actually went up in value as investors ran from stocks in a panic, looking for safety. But in 2025, bonds are crashing right along with stocks because the U.S. government has issued so much debt that the bond market simply can't handle it anymore. Total federal debt is now over $36 trillion, which is about 125% of GDP. This is the exact same debt-to-GDP ratio America had at the end of World War II. The big difference, though, is that after the war, America was the only major economy that hadn't been completely destroyed. Today, America is competing with countries that have much lower debt and much stronger economies. The yearly interest payment on this debt is now over $1.2 trillion, which is hard to believe, making it the single largest expense in the entire federal budget, bigger than defense spending, even bigger than Social Security. When your interest payments alone are more than everything else, the government basically has three equally terrible choices: cut spending drastically and cause a recession, raise taxes drastically and cause a recession, or print money to pay the debt and cause runaway inflation. All three choices will inevitably lead to an economic crisis. There's just no good way forward when your interest payments alone are equal to the entire GDP of Mexico. This is the everything bubble in a nutshell. Stocks overvalued to levels only seen twice before, both times right before major crashes. Real estate even more overvalued than it was in 2008, and bonds, normally a safe haven, now crashing under the overwhelming weight of unpayable government debt. The similarities between 2025 and 1929 are so strangely accurate that it's like watching history repeat itself, scene by scene. In 1929, stock valuations reached levels that had never been seen before. The price-to-earnings ratio of the Dow Jones Industrial Average hit an unbelievable 33, which was far beyond anything in the past. In 2025, we're seeing similar levels of craziness, with the S&P 500 trading at 28 times earnings. People in 1929 were sure that new technology, specifically electricity, the radio, and the automobile, had created a permanent, new economy where the old rules for valuation didn't apply anymore. "This time is different," was the phrase that was constantly repeated throughout 1929. In 2025, artificial intelligence is the new technology that supposedly makes all the old rules useless. In 1929, margin debt, money borrowed to buy stocks, reached record levels, as everyone from doctors to shoeshine boys borrowed as much as they could to join in the boom. Stories went around about ordinary people becoming incredibly rich overnight through stock speculation. In 2025, margin debt as a percentage of GDP is at similarly extreme levels, but modern borrowing goes far beyond traditional margin accounts. Options trading by regular investors has exploded. People are using credit cards to buy stocks. Companies are borrowing money to buy back their own shares at wildly inflated prices. There's borrowing everywhere in the system, hidden in complex derivatives, options, and debt structures that most people just don't understand. Wealth inequality in 1929 had reached extreme levels, with the top 1% controlling about 25% of total income. This extreme concentration meant that the entire economy depended heavily on a small number of incredibly wealthy people continuing to spend and invest. When they stopped, the entire system collapsed. In 2025, wealth inequality has actually reached even higher levels. The top 1% now controls about 32% of total wealth, which is even higher than it was in 1929. The economy depends heavily on the top 10%, who control an unbelievable 70% of all consumer spending. If the wealthy stop spending because their stock portfolios crash, consumer demand will disappear almost overnight. and the economy will inevitably collapse. But here's the real kicker. 2025 is actually worse than 1929 in one incredibly important way. In 1929, most Americans weren't actually in the stock market. Only about 10% of households owned stocks, which meant that 90% of the population wasn't directly affected by the stock crash. They definitely suffered later through unemployment and deflation, but the initial crash didn't wipe out their savings because they simply didn't have any savings invested in stocks. In 2025, about 58% of American households own stocks, either directly or through retirement accounts like 401(k), and IRAs. This means that when the market crashes, it will directly destroy the retirement savings of more than half the country. There's no protection, no safety net. Everyone suffers right away. The banking sector in 1929 was made up of thousands of small, independent banks with no federal insurance. When the crash happened, banks failed in large numbers because depositors panicked and took their money out. The lack of deposit insurance meant that bank failures wiped out ordinary people's savings. In 2025, we supposedly have FDIC insurance that protects deposits up to $250,000. But the FDIC only has about $125 billion in its fund, while insuring about $10 trillion in deposits. If multiple large banks fail at the same time, the FDIC fund is laughably insufficient. The government would have to print trillions of dollars to make depositors whole, which would completely destroy the currency through runaway inflation. Either depositors lose their money through devastating bank failures, or they lose their money through crippling inflation. Take your pick of the poison. The Federal Reserve in 1929 still had credibility and the ability to act. It had only been created in 1913, just 16 years earlier, and hadn't yet destroyed public confidence through decades of boom-bust cycles. They could have cut interest rates more aggressively, but they just didn't fully understand what they needed to do until it was too late. In 2025, the Federal Reserve has spent the last 15 years proving beyond any reasonable doubt that it just can't effectively manage the economy. They created a massive bubble through quantitative easing after 2008. They kept interest rates way too low for way too long, which directly created the everything bubble we're now facing. Then, they raised rates way too aggressively in 2022 and 2023, causing runaway inflation while also threatening to crash the economy. The Fed has completely lost its credibility. More importantly, it's lost the tools it needs to fix the next crisis. The 2008 financial crisis provides an even more recent and relevant comparison to what's coming in 2025 and 2026. In 2008, the crisis started with subprime mortgages, loans to people who simply couldn't afford them that were then packaged into complex securities and sold to investors worldwide. When housing prices stopped going up, borrowers couldn't refinance and started defaulting in large numbers. The defaults spread through the entire financial system, showing that banks were heavily overborrowed and holding trillions of dollars worth of worthless mortgage-backed securities. In 2025, subprime lending is everywhere, except we've conveniently renamed it, so it doesn't sound quite so bad. Auto loans with 84-month terms at sky-high interest rates to people with terrible credit. Credit card debt at record levels, with average interest rates exceeding a mind-boggling 21%. Student loans totaling a staggering $1.77 trillion that will simply never be fully repaid. Corporate debt that has quintupled from $2 trillion in 2008 to over $10 trillion today, as companies borrowed at ridiculously low rates to buy back their own stock. The borrowing in the system in 2008 was mainly focused on housing and mortgage-backed securities. Banks like Lehman Brothers were borrowed 30-to-1. Meaning they had $30 of assets for every single $1 of capital. When those assets dropped by even 3%, the bank was wiped out. Lehman collapsed in September 2008, causing the worst financial panic since the Great Depression. In 2025, borrowing isn't just focused on one area. It's absolutely everywhere. The derivatives market is now over $600 trillion in notional value, which is 10 times the entire global GDP. Most of these derivatives are interest rate swaps and credit default swaps that would explode if interest rates move dramatically or if major corporate defaults begin. The interconnectedness means that one failure will cause others, which will then cause others in a chain reaction that just can't be stopped. In 2008, the Federal Reserve had powerful tools it could use to deal with the crisis. Interest rates were at 5.25% when the crisis started, giving the Fed plenty of room to cut all the way down to zero. This encouraged borrowing and spending, which helped to stabilize the economy. The Fed could also use quantitative easing, buying trillions of dollars worth of treasury bonds and mortgage-backed securities to put desperately needed money into the financial system. The Fed's balance sheet went from a fairly small $800 billion before the crisis to an unbelievable $4 trillion by 2014. This unprecedented money printing helped to avoid a complete collapse, but it also created the very bubbles we're struggling with right now. In 2025, interest rates are already relatively low, giving the Fed very little room to cut. If they cut rates dramatically, they risk reigniting the very inflation that just needed painful rate hikes to bring under control. If they don't cut, they basically let the economy crash into a full-blown depression. Quantitative easing is also limited in 2025. The Fed's balance sheet is already over $7 trillion after multiple rounds of QE, following 2008 and then again during COVID. They can definitely print more money, but everyone now understands that printing money will cause inflation. The 2021 to 2023 inflation surge, the worst we've seen in 40 years, proved that you just can't print unlimited amounts of money without destroying the currency's value. The Fed is basically trapped. Print money and destroy the dollar through runaway inflation. Don't print money and let deflation create another Great Depression. There's no good choice left because the tools that worked, in 2008 just don't work anymore after being used so much. The government's ability to bail people out is also completely used up. In 2008, the government could borrow a lot of money to bail out the banks because federal debt was only about 67% of GDP, which was manageable by past standards. The Troubled Asset Relief Program, or TARP, authorized $700 billion to buy bad assets from banks. Additional programs brought the total bailout close to $2 trillion. This was politically unpopular, for sure, but it was economically possible because the government still had a lot of borrowing power. In 2025, federal debt is an unbelievable 125% of GDP, with trillion-dollar deficits as far as you can see. The government just doesn't have another $2 trillion to bail out failing banks and corporations. If they try to borrow it, bond markets will revolt and interest rates will spike even higher, making the debt payments even more unsustainable. The bailout option that saved the system, at least for a while, in 2008 just doesn't exist in 2025. The international situation also makes 2025 much worse than 2008. In 2008, China was booming and helped pull the global economy out of recession by strongly encouraging domestic demand and buying up commodities. Europe, while definitely affected by the crisis, wasn't in the same kind of deep debt as the United States. Global cooperation through the G20 actually coordinated efforts to boost the economy. In 2025, China is going through its own economic crisis, with a collapsing real estate sector, local government debt over $13 trillion, and a looming demographic crisis as the population gets smaller. Europe is struggling with an energy crisis, a shrinking population, and growing political divisions. There's just no major economy in a position to lead a global recovery. Rising political tensions mean that real cooperation is very unlikely. When the crisis hits, every country will be fighting for its own survival instead of working together on global solutions. The most reliable sign of recessions over the last 70 years has been the inverted yield curve. When short-term interest rates are higher than long-term rates, this has accurately predicted every single recession since 1950, with no false alarms. The yield curve inverted in July 2022 and stayed inverted for a full 27 months, finally returning to normal in September 2024. History shows that recessions usually begin 3 to 12 months after the yield curve returns to normal, not while it's inverted. This means the danger window is October 2024 through September 2025. We're in that window right now. The signal that has never been wrong is telling us that a recession is coming soon. Consumer debt has reached levels that make the 2008 crisis look almost manageable. Credit card debt is over $14 trillion, an all-time high in dollar terms. The average credit card balance is $6,800 per household, with interest rates averaging a crippling 21 to 28%. Credit card delinquencies, the percentage of borrowers 90 days or more behind on payments, have risen to levels not seen since 2011. This is important because consumer spending makes up a massive 68% of the U.S. economy. When consumers can't borrow anymore and have to start paying down debt instead of spending, the economy will shrink. We're quickly approaching the point where consumers are maxed out. They just can't keep the spending going that the economy badly needs. The commercial real estate crisis is happening slowly, but it will speed up a lot throughout 2025 and 2026. Over $2 trillion in commercial mortgages are coming due during this time and absolutely must be refinanced. These properties were financed when interest rates were around 3%. Today's rates are 7 to 9%. A building that barely made enough money at 3% interest is basically bankrupt at 8% interest. The math just doesn't work. Building values have already dropped 40 to 60% in many markets because buyers know that the properties can't support the debt at current rates. When these mortgages can't be refinanced, the owners will default and just give the keys back to the lender. Regional banks holding these mortgages will have huge losses that will wipe out their capital. Regional bank failures in 2023 were a warning sign that almost no one paid attention to. Silicon Valley Bank collapsed in March 2023 in the second-largest bank failure in U.S. history. Signature Bank failed the same week. First Republic Bank failed in May 2023 and was taken over by J.P. Morgan at a huge loss covered by the FDIC. New York Community Bank was close to collapse in January 2024. These failures all happened even though we weren't even in a recession. When the recession hits and loan defaults surge, many more regional banks will fail. The FDIC will run through its small $125 billion insurance fund in a matter of weeks. The government will then have to print a lot of money to cover the deposits, completely destroying the currency's value. The concentration of market value in just 7 stocks, the so-called Magnificent Seven, creates a level of fragility that just didn't exist in the past. Apple, Microsoft, Nvidia, Amazon, Google, parent Alphabet, Meta, and Tesla now make up an unbelievable 30% of the S&P 500's total market value. Nvidia alone, with its crazy price-to-earnings ratio above 65, makes up about 7% of the entire index. If Nvidia's earnings are disappointing, or if the AI hype suddenly fades, the stock could easily drop 50 to 70%. That one stock declining would take the entire market down with it. This level of concentration risk is unprecedented. When the market crashes, these 7 stocks will lead the decline. And because they make up such a large part of the index, the crash will be much faster and more severe than anything we've seen before. Insider selling has reached levels that have historically come before major market declines. Corporate executives have access to information that ordinary investors just don't have. They see the real earnings, the real pipeline, the real problems long before anyone else. When they start selling a lot of their own company's stock, it's a clear sign that they don't believe current prices are sustainable. Jeff Bezos sold over $13 billion worth of Amazon stock throughout 2024 and 2025. Mark Zuckerberg has been selling billions of dollars worth of Meta stock. Nvidia executives, even as the stock was hitting new all-time highs, were quietly selling shares. This is exactly what happened in 1929 and again in 2000. Insiders know when valuations are completely crazy, and they get out before the crash. Or consider Warren Buffett, arguably the most successful investor in history, who is hoarding cash at levels he's never had before. Berkshire Hathaway's cash position is over $325 billion, the highest in the company's history, both in dollar terms and as a percentage of assets. Buffett has been actively selling stocks, including significantly reducing his large Apple position and buying treasury bills. When asked why, he said that valuations were just too high and that he couldn't find good investments. Buffett's own metric, the Buffett Indicator, which divides total stock market value by GDP, is at an unbelievable 185%. He has said that a reading above 120% shows dangerous overvaluation. At 185%, the signal couldn't be any clearer. The world's best investor is sitting on a mountain of cash, waiting for the crash because he knows it's coming. Unemployment has already started to rise from the 3.4% low in early 2023 to 4.1% by October 2025. While 4.1% is still relatively low, the direction of change matters more than the level itself. The Sahm rule, created by economist Claudius Sahm, says that when the 3-month average of the unemployment rate rises 0.5 percentage points above its low of the past 12 months, the economy is officially in a recession. This rule has accurately predicted every recession since 1970, with no false alarms. As of October of 2025 finds us perched precariously on the edge, right at or very close to the threshold that sets off the Sahm rule. There's no denying that unemployment is on the rise, and history tells us that once that starts, it picks up speed as layoffs lead to even more layoffs. Delinquencies on auto loans have skyrocketed to levels we haven't seen since the financial meltdown of 2008. Right now, about 7.5% of auto loans are past due by 90 days or more, which is the highest rate since 2009. The average monthly payment for a new car loan is an eye-watering $740 plus, and loan terms have been stretched out to an absurd 84 months, a full 7 years of payments. Let's be honest, this is basically subprime lending dressed up with a slightly different label. People who simply can't swing it are being handed loans they have zero chance of repaying. And when they default, it's not just the lender who takes a hit. Their ability to get to work is compromised, creating a domino effect where job loss follows the repo man. This is a crystal-clear warning sign of broader financial strain in the consumer sector. Student loan delinquency rates have shot up since payments were restarted in October of 2023 after a 3-year break, thanks to the pandemic. The total amount of student debt outstanding is a staggering $1.77 trillion, spread across 43 million borrowers. A lot of people are choosing to just default rather than start paying again, fully aware that the debt is so massive they'll never be able to pay it off anyway. This is sucking $100 billion or more out of the economy every year as young people are forced to put their lives on hold, using their money to service debt instead of buying homes, starting families, or spending on goods and services. The very generation that should be fueling economic growth is instead drowning in debt that provides absolutely no economic return. The geopolitical landscape in 2025 is fraught with risk. We've got ongoing wars in Ukraine and the Middle East, the ever-present threat of China invading Taiwan, and the increasing fragmentation of global trade into competing blocs. Any one of these situations could easily escalate into conflicts that disrupt the supply of critical resources like energy and food, or completely unravel critical supply chains. An oil price shock similar to what we saw in the 1970s would trigger stagflation, that horrible mix of inflation and recession that's even harder to deal with than a recession on its own. Markets hate uncertainty more than anything, and in 2025, geopolitical uncertainty is as high as it's been since the 1970s. Commercial real estate defaults are already starting to happen with some major institutional owners. Brookfield Asset Management defaulted on 2 prominent office towers in Los Angeles back in 2024. Blackstone, which is the world's biggest commercial real estate owner, has been struggling to keep up with redemption requests from investors who want their money back. These are the sophisticated players, the smart money, who are walking away from properties because the numbers just don't add up at current interest rates. When the big boys start defaulting, that's a clear indication that the fundamentals are fundamentally broken. The defaults are going to spread like wildfire throughout 2025 and 2026 as more mortgages come due, triggering bank losses, more defaults, and eventually, bank failures. The crash isn't going to announce itself with a clear, obvious starting point that everyone immediately recognizes. It's going to start with something that seems relatively manageable at first, an earnings miss by a major tech company, a larger-than-expected failure of a regional bank, an escalation in a geopolitical conflict, or a breakdown in negotiations over the debt ceiling. The specific trigger itself almost doesn't matter because the system is so incredibly fragile that any shock will be enough to start the downward spiral. What really matters is what happens next, how one failure leads to another, which then leads to another, until the entire financial system is in a full-blown freefall. When NVIDIA or another one of the Magnificent Seven stocks misses earnings projections or provides weak guidance for the future, algorithmic trading systems are going to start selling instantly. The stock could easily drop 10 to 15% in a single day. Because NVIDIA accounts for 7% of the S&P 500, that alone would drag the index down by zero. But the real damage will come from the psychological impact. If the AI story that's driven valuations to such insane heights starts to fall apart, investors are inevitably going to start questioning all tech valuations. Microsoft, Apple, Amazon, Google, Meta, and Tesla would all sell off in sympathy. Within a matter of days, the Magnificent Seven stocks could plummet by 20 to 30%, dragging the entire market down with them by 6 to 9%. This downturn will likely set off a wave of margin calls, which tend to act as an accelerant, transforming a simple market correction into a full-blown crash. When investors use borrowed money to buy stocks, and those stocks subsequently lose value, their brokers demand additional collateral to secure the loan. If the investor doesn't have the cash to cover it, the broker will liquidate the stocks to cover the outstanding debt. This forced selling further depresses stock prices, leading to more margin calls and triggering even more selling. Back in 1929, margin calls created a vicious downward spiral that proved impossible to stop. By 2025, margin debt as a percentage of the overall market value is projected to be alarmingly similar to the levels we saw in 1929. When the selling pressure starts, it's expected to be rapid and relentless. Institutional investors, who are responsible for managing trillions of dollars in pension funds, endowments, and sovereign wealth funds, operate under strict risk management protocols. These rules often require the sale of assets when markets decline beyond predetermined thresholds. These aren't emotional reactions. They are pre-programmed, automated processes. When stock prices fall by 20%, risk management systems automatically initiate selling to prevent further losses. This widespread institutional selling only makes the downward pressure worse. Within the first month of the crash, stock prices could easily plunge by 30 to 40% as panic selling by retail investors, margin calls, and institutional risk management strategies all converge to drive prices lower at the same time. The contagion then spreads from stocks to bonds as investors desperately seek the perceived safety of fixed-income assets. However, in 2025, Treasury bonds might not offer the safe haven that many are expecting. The government is going to need to issue trillions of dollars in new debt to cover existing deficits and refinance maturing obligations. If there's a simultaneous flight to safety and the government's need to sell bonds, interest rates are likely to spike even higher. This creates a potentially devastating feedback loop. Higher interest rates will increase the government's debt service costs, necessitating even more borrowing. This, in turn, requires the issuance of more bonds, which further drives up interest rates, and so on. Countries trapped in this kind of self-reinforcing cycle typically face either default or currency collapse due to hyperinflation. The housing market is also expected to freeze up as potential buyers disappear and sellers become unwilling to accept lower prices. Homes could sit on the market for months without receiving a single offer. Individuals who need to sell because of job relocations or pressing financial circumstances will start cutting prices. These price reductions will establish new benchmarks, driving down the assessed value of all homes in the area. Within 6 months, home prices could easily fall by 20 to 30% from their peak values. Within a year, declines of 40 to 50% are entirely plausible in overvalued markets like Austin, Phoenix, Boise, and certain regions of California and Florida. Homeowners who bought their properties within the past 3 years could find themselves underwater, owing more on their mortgages than their homes are actually worth. Commercial real estate defaults will likely accelerate as property owners realize they can't refinance their maturing mortgages. Many will simply stop making payments and hand the keys back to the lender. The lender, typically a regional bank, will then take possession of a property that's worth 40 to 60% less than the original loan amount. This constitutes a realized loss. When banks experience massive losses on commercial real estate loans, it will eat into their capital reserves. Banks are required to maintain minimum capital ratios, and when those ratios fall below the regulatory thresholds, regulators will be forced to close the bank. During the 2008 crisis, 465 banks failed over a 5-year period. In the coming crisis, we could see similar or even higher numbers of bank failures, concentrated within a much shorter time frame. Bank failures will likely create widespread panic that spreads to banks that are actually solvent. Depositors, seeing the collapse of other institutions, will rush to withdraw their money from any bank they perceive as risky. This would trigger a classic bank run. Even healthy banks don't keep enough cash on hand to satisfy all depositors simultaneously, as they've lent out or invested those funds. When a bank run starts, the bank will be forced to sell assets to raise cash. Selling assets at fire sale prices generates losses that can quickly render a healthy bank insolvent. The Federal Deposit Insurance Corporation, FDIC, will step in to guarantee deposits, but its $125 billion insurance fund is unlikely to be enough to cover multiple large bank failures. The government will then have to print money to cover those deposits, kicking off an inflationary process that could ultimately destroy the currency's value. Employment is going to plummet as companies facing declining revenues cut costs through layoffs. Tech companies, which saw rapid growth during the boom years, will start laying off 10 to 20% of their workforce. Financial companies heavily exposed to market declines will also reduce staff. Consumer discretionary companies, facing customers who can no longer afford to spend, will close stores and eliminate positions. Within 3 months of the crash starting, unemployment could rise from 4% to 7 or 8%. Within 6 months, a 10% unemployment rate is realistic. Within a year, unemployment could reach 12 to 15% as the cascading failures spread throughout the economy. The Federal Reserve is going to face an impossible dilemma. It could cut interest rates and implement quantitative easing to try to stabilize markets. However, this risks reigniting inflation before it's been fully tamed. The memory of the 2021 to 2023 period, when inflation hit 9% and severely eroded purchasing power, is still fresh in everyone's minds. If the Fed prints trillions of dollars again, the dollar's value could collapse, and inflation could come back even worse than before. Alternatively, the Fed could let the crash play out, which would mean depression-level unemployment and a decade of economic stagnation. There's no middle ground. The tools that worked in 2008 won't be effective in 2025 because they've already been overused, and the consequences are now widely understood. For the average American with a 401k or IRA, watching their retirement account decline by 60 to 70% is going to be a devastating experience that goes far beyond just the numerical loss. Someone who's diligently saved for 30 years and accumulated $600,000 in their retirement account could see it plummet to $200,000 or less. This isn't just a market correction. It's the destruction of their financial future. They may no longer be able to retire and may have to work for 10 to 15 more years, assuming they can even keep their job throughout the recession. For individuals who are already retired and relying on portfolio withdrawals to cover living expenses, the situation is even more dire. They'll be forced to sell assets at rock-bottom prices to pay bills, locking in losses that they may never recover. The psychological impact of watching everything you've saved disappear will be profound. In 2008, retirement accounts declined significantly, but they recovered within 5.5 years. Most people who held on eventually recouped their losses. However, in the coming crash, recovery could take much longer, if it happens at all. Japan's stock market crashed in 1990 and didn't return to those highs until 2024, a full 34 years later. An entire generation of Japanese investors never recovered their wealth. The same thing could happen in America if the crash is severe enough and the recovery takes decades. The destruction of housing wealth will trap millions of Americans in homes they can no longer afford to sell. The job market for young people entering the workforce is going to be exceptionally tough. College graduates in 2026 and 2027 might find that there are no entry-level positions available. Companies probably won't be hiring, and the few jobs that do exist will attract hundreds of applicants. This generation could start their careers 5 to 10 years behind where they should be, which will suppress their lifetime earnings. Studies of individuals who graduated into the 2008 recession have shown that they earned less over their entire careers compared to those who graduated a few years earlier. The coming crash is projected to be worse, meaning the economic scarring will be deeper and more persistent. Small businesses are going to be decimated as consumer spending collapses and credit becomes unavailable. The local restaurant, the small retail shop, the family-owned service business, these will fail by the hundreds of thousands. Large corporations with access to capital markets will survive, albeit in a weakened state. The economy that emerges from the crash will likely be even more dominated by massive corporations, with small businesses playing a less significant role. This reduces competition, innovation, and overall economic dynamism. Social safety nets will be stretched beyond their capacity as unemployment surges and tax revenues plummet. The government will be caught between increasing demands for services and a decreasing ability to fund those services. Spending cuts will become necessary, even as more people require assistance. This creates a humanitarian crisis in addition to the economic crisis, as vulnerable populations, the elderly, the disabled, and the unemployed face reduced support at the moment they need it most. Political instability often follows economic collapse. The 1930s saw the rise of extremist movements across Europe as economic desperation made people susceptible to authoritarian promises. Weimar Germany's hyperinflation helped to create the conditions that brought Hitler to power. The United States isn't immune to the political consequences of economic catastrophe. When people lose everything, they tend to look for someone to blame and someone who promises radical solutions. The 2025 crash will likely reshape American politics in ways that are currently unpredictable, but that will likely be destabilizing. So, why is 2025 projected to be worse than 1929 and 2008 combined?